Managed futures is a subclass of alternative investment strategies. In particular, trend following is a strategy where across multiple asset classes, including equities, fixed income, currencies, and commodities, we take long or short positions and follow key market macro themes over time as they evolve and change. And as you can imagine, in a year like this year, there's been a lot of change and a lot of disruption in those markets. So some of the things that are important for investors to understand about these strategies are that they have low correlation to stocks and bonds, and that they've tended to do well during periods of dislocation and market stress. 2022 has been a stellar year for managed futures. It might seem counterintuitive because it's been a very difficult year for both stocks and bonds. And what's been interesting for us from a managed futures perspective is that we've been following some of the key macro themes this year. First of all, rising rates and the potential for a changing regime in the fixed income markets. And second of all, the impact of inflation. And how has that manifested itself in our portfolio? Well, we've had a very neutral stance on equities, but we've been short in fixed income and long, particularly in many of the different commodity sectors which have benefited from inflationary moves. Managed futures is a strategy that's often associated with crisis alpha. Crisis alpha is the opportunities during periods of difficult market environments. If you think about what makes a potential strategy successful during these periods, it's about adapting dynamically and being able to capture new and perhaps unexpected opportunities during a period of stress. One particular thing that we've seen this year, which highlights how important it is not to try and time a crisis, but that managed futures itself will adjust to crises, is if we compare this year's crisis, we've seen profitable opportunities short bonds and long energies and long commodities, whereas if you look 2 years ago in the COVID event, we actually had the opposite positioning where we were short energies and long fixed income. So really, every crisis is unique and it provides very different trends which can help offset the potential challenges for your own portfolio. I never suggest timing dynamic trading strategies like trend following because the truth is we're a strategy that likes macro uncertainty. And as long as macro uncertainty is high, you're going to see changing trends across time, which will evolve as the markets evolve. And so in an environment where there's a lot of stress, or there's changing structural effects within markets, you're gonna see more different and diversifying trends that we can follow. And any of these trends could be any of the above. It could be anything from a recession to a correction in the commodity markets to a potential move higher in interest rates going into the second half of this year. Either way, we'll be following what markets are doing, not trying to tell you what they should do. So I think the biggest surprise this year has been the success of the short bond trade. This is a position that hasn't worked for at least since 1994. So it's not really a trade that you would have expected to be successful, but it's been a really interesting environment where we've actually started to see the potential for us to move into a new macro regime. And being able to short bonds had tremendous value this year because it's something that was so unexpected. As a quant, we love data. And what's more interesting is if you look over longer time horizons and you look at different inflationary periods and you also look at rising and falling rate environments, you actually see very different patterns in asset class returns and the behavior of trend signals as a whole. So over the last 40 years, we've been in a falling rate environment. In a falling rate environment, we've tended to be about 70% long, and that's been the right choice most of the time. On the other hand, if you look more closely at periods of rising rate environments, it's actually very different. You see very different asset class themes, and we tend to be actually more often short than long, something we're not used to seeing that often. That's why this year has been so surprising, because it has so many features that mirror what we saw in a rising rate environment. So This year has been already a very long and very extreme year in many ways. As we've shifted more from an inflation, rising rate narrative to a question about if we have a recession, we've started to see a few key things in asset class prices and in the data that we look at. First of all, we're seeing increased volatility across multiple asset classes. We're also seeing increased correlations across the different assets we trade. And finally, we've seen a few more short signals in the stock market, which is an indication that there's a little bit more chance of a recession that might occur in the second half of this year. Managed futures is a strategy that likes macro uncertainty. We're also very dynamic. And these trends, they change over time. So as those trends evolve, our positions change with them. The next themes, we don't know what they'll be. They could be anything from a recession to rising rates continuing to a potential correction even in the commodity markets. Either way, as long as there's a lot of uncertainty and things are stressful, we tend to find interesting opportunities, particularly when stocks and bonds are more challenged. And so from my perspective, we could actually go into a prolonged period where there is more macro uncertainty and more opportunities for new trends that we haven't seen in what has been a relatively calm period for asset class returns in the last few years.